All right, now I want to talk about one way of investing that you might hear about is through it's called an index fund, or you can hear maybe a mutual fund or ETF. They're all very similar. They have some differences between them, but for a novice investor coming in, the easiest way to think about an index fund is to think about a individual stock. So I'm going to just pull up a chart of a stock that we know of, and that's going to be Walmart. I'm sure everybody knows what Walmart is. And this is a performance chart of Walmart. It's pretty simple. I'm going to zoom out, and this is going to show you this is going to show you the historical performance of Walmart stock. In this case, this is a website called finviz.com. I like it for quick graphs. And you can see that back in 2011, October of 2011, Walmart was trading at roughly $51. You can see that it went up. You see it went down. You see it went up. You see it went down. You can see that it's been up. And then now recently, the stock market's actually been taking a beating as of this recording. So you can see it's down precipitously from its highs. If you scroll down a little bit, you'll see that it's actually from its 52-week high, it's down 25%. And down here, you'll find information about the company. So for example, it shows you that it's in the Dow Jones and S&P 500 index, shows you the value of the company, its income, its sales, it shows you if it pays a dividend. Lots of information here. You can spend days watching videos on the stock market, but this is just a quick overview. All right, back to it. So here we have a chart of Walmart, and when we look at individual stocks, which I'll make another video for, individual stocks obviously carry individual stock risk. So in other words, if you're looking at a company that's doing very well, you can see that in, let's see, about 11 years time, you could have turned $50 to, a high here of about $150. So you could have tripled your money in about a 10-year period. Okay. And there's other stocks that performed exponentially, had exponentially greater returns on your growth stocks, for example. However, with that same individual stock risk, we could look at a company like Zoom. I'm going to zoom out here. Actually, no, I'm going to come here again. Zoom, you'll remember, was a company before COVID. And then obviously, even if you don't understand stock market, you can understand that a company that's publicly traded like Zoom, when the pandemic hit, it would have a tremendous rise, right? Because that people are using it, it's getting lots of attention out there. So you can see a huge rise. So Zoom went from, in the beginning of 2020, in January, went from trading at like $70 all the way up to a little over $500. Okay, so you can see that was an exponential growth in a short period of time, less than a year. Your money could have grown exponentially. But then at the same time, once that hype around the company kind of faded and we saw, okay, the vaccines were coming out and, we weren't going to stay remote forever, then investors, they started saying, okay, well, I'm going to pull some of that money back. And then the stock price experienced a decline. And then now you can see this was a steep decline. So looking at that same number here, Zoom stock is down 78% from its 52-week high. So in other words, if you were buying up here and you said, oh, Zoom is the best thing in the world, at $550, you would have turned your $555 investment into $89. And that's what scares people about the stock market, right? Because they say, oh, it's risky, which it is. Anytime you're investing, you're seeking a return, which means inherently that you're going to have to take on risk. However, the good thing is, and I'm going to quickly talk about this, that there's things like the index funds where you can invest in the broader market. So you go to your brokerage account, you create your account, you fund it. You then go and do some research on index funds. And I'm going to touch on just a couple of them that are really the tried and true ones. And we're going to look here at just a couple of them. One is going to be the QQQ, and this one, the Invesco QQQ Trust ETF, is an index fund that tracks the performance of the largest non-financial companies in the NASDAQ 100 index. This ETF started trading in 1999. It's managed by Invesco, which is a giant fund. And it's one of the top performing, or it says it is the top performing large cap fund in terms of total return over 15 years to September 2021. And then it shows you the expense ratio. So these ETFs, they pretty much take, I'm going to go ahead and zoom in here. They take a basket of stocks. So I flipped over to another website here. Sorry, a lot of ads. I just want to show you this. So I flipped to a database of ETFs. And again, this is things you can Google. I'm going to click holdings here. Okay. So for the QQQ that we just looked at, what they did, this group, to make this ETF, they pulled some of the biggest companies that you're familiar with, and they just weight them differently in the ETF. So instead of taking $550 and buying Zoom, or $50 and buying Walmart, or $2,000 or $3,000 to buy Amazon, I can buy this ETF, which has exposure to all of these different companies. So it gives you a little mix of everything. Okay? Just some of those companies there. And I'm going to see if I can find to actually find the holdings. Just went straight to Google, and I Googled QQQ holdings. Okay? I'm going to go straight to the Invesco site. Okay. And I'm going to, okay, there's the number of holdings. Here again, they're showing the top 10 holdings, but I want to see all. There we go. I want to see all of the holdings. Okay. So here you see they have Apple, Microsoft, Amazon, Tesla, okay, Nvidia, Broadcom. These are semiconductors. PepsiCo, Comcast. See, these are all companies that you're familiar with, that you have products of, right? T-Mobile, Quail Comics, Chips, PayPal, if you're familiar with that. Booking Holdings, right? So that's travel. And what I'm looking for is I'm going to see there's Netflix. I'm just looking to see if Zoom is a part of this holding here. Yep, and there it is. Almost passed it. Okay. So you can see in this index fund, they have a allocation of Zoom, which is about, it's 0.2% of their entire holding. And when I look at the performance of the QQQ, you can see that it's down because the QQQ tracks technology companies heavily. That's what the NASDAQ's mostly consists of, as you saw before with the Apple, Microsoft. So you can see that the Qs are down. So all of those companies in the aggregate are down. But notice this. You'll notice that the Qs it's down 29%, which is it's a big decline, as you can see from its historical chart. You can see that it mostly goes top right, it's mostly going up, and that this is a rather large decline. But again, by being in the QQQ ETF, you would be down 29%. However, that's a lot better than being down 77%, at least in the short term. So for an investor that is interested in being a participant in the stock market, the QQQ might be a good place to start. Now, going back, you can see that if you wanted to track the S&P 500, you would buy the symbol. It's SPY. They call it SPY. That would give you exposure to the S&P 500. Okay, and I'm just going to come here, type in SPY. Okay, and you can see how that's performed. And again, when you think back to our calculator, you're looking at a 10% on average. So you can see some years pretty small, And then you have some years where you have just these massive gains. And when you look at it, it is over time where you'd be at the 10% mark on average annual return. Okay. Again, these are the largest ones. If maybe you don't want the SPY, which is it's just one company's. It's the Spider SPDR. It's their fund that they put together that tracks S&P 500. But you can see that there's another company that offers iShares Core S&P 500, and then Vanguard, which is an investment like a huge firm. They also have the VOO, so the VOO, which also tracks S&P 500. We looked at the Invesco that actually tracks the NASDAQ, but you can see there's different companies there. And this AUM, this is the asset under management. So one point to make is that when you're looking at these and you're like, well, I don't know if I can invest, I don't have the knowledge. Here's the thing. If you were to go and look at a prospectus of what you currently hold in your 403B, I can guarantee you that you're going to see a lot of these same names there. Because these are the Cadillac classes of ETFs. These are really the Cadillac companies there. And you'd want to research and find the one that's good for you. Again, I can't stress that enough. But they have such a diversity of ETFs. That's something else. Maybe I want exposure to dividends or maybe healthcare. So I'm going to go with XLV. And this is health and biotech. And I want to look at the holdings in there. There you go. So maybe you're interested in healthcare. You're like, you know what? That seems like a good bet. And I'm going to look Johnson & Johnson, United Health Group, Pfizer, AbbVie, Eli Lilly and Company. So you can have it that way. Yeah, if you were interested in blockchain or Bitcoin holdings, for example, you have this ETF called Block. And it doesn't hold Bitcoin directly, but it holds companies that mine Bitcoin, holds companies that maybe hold actual physical Bitcoins on their balance sheets. And again, you can see Bitcoin's getting slaughtered if you watch the news, and this getting slaughtered as well. However, if and when it recovers, then this will also, kind of track that as well. So I know this was a lot of information, but I just wanted to show that it's definitely a possibility for you to be involved in the stock market. It's something that you could research, and you could just do something simple. You could say, I'm going to go ahead and buy, put $1,000 in. I'm going to buy, let's see, 2 shares of SPY at close to $400 a piece. And then maybe you want some Bitcoin exposure, and maybe you buy some of this block, or maybe you say, I want some of this, and I also want the QQQ for some NASDAQ exposure. If you believe that technology is going to continue to outperform over the next couple years or decades, then you might buy one of these. And then over time, remembering your long-term time horizon and knowing that over time that these returns will be substantial, because when we plug in our same assumptions and we say 30 years at 10% with a $100 contribution, now we can really see the benefit here, where we could on our own put $1,000 in, $100 a month, 30 years at 10%, and we'd be sitting on $223,000. And if you don't believe that the 30 years will be here, just if you've been in the business, if you've been teaching for a while, I can guarantee you know that time flies like this. And if you're new to the profession, you're just getting started, maybe you're in your 20s, now would be the time to invest a little bit, whether it's in stocks, real estate, art, collectibles, Legos, something. Find something that you understand and that you can understand and see the rate of return come to your benefit, because it will have a substantial impact when you look back 30 years from now. Okay. Again, I know it's a lot of information. Just wanted to give you a glimpse into the potential and how you could dabble into the stock market. This is not financial advice. You're going to have to do your own due diligence, but it's definitely worth taking a look into. And as always, this is Dr. Diffins. I thank you for your time. This is Dr. Diffins signing off. Bye-bye.